Now, we've talked about dividends a lot on this channel, but you'd be surprised to know that dividends actually could be impacting your ability to grow a huge wealth portfolio. And we need to talk about it in today's video, and it's based on a recent comment that I received on one of my $5 a day investment videos. And by the way, this is a community YouTube, so comment down below with whatever personal finance question you may have, and who knows, maybe I'll feature your comment in the next video. So let's take a look at this particular comment. We put $5 every single day into SVOL, that's an ETF fund, since October of 2022. Congratulations, that's 2 years of consistency. Absolutely amazing. And they got $89 in dividends today. And that's $89 a month because they've built up so much of a portfolio. Key point here is, so we beat VOO. Now, if you're not familiar with the channel, VOO is what I invest in, and I invest $5 every single day, all the way back from January of 2022 to today and ongoing. Because if you look at only dividends alone, that's amazing. Congratulations. This dividend paying ETF, SVOL, pays dividends every single month, which means you get an extra payment, and you can do one of two things with that. You can take that money and go buy a beer with it or something, or you can reinvest it into the fund, making you more and more money. It's what we call the dividend snowball. But you're going to be surprised to find out that I'm actually beating SVOL with VOO. Maybe not in dividends, but in total money. Dividends could be hurting our portfolio, and because we're so focused on dividends, we're missing out on massive amount of money. It's like you're leaving money on the table because you're so focused on dividends. And I want to be very cautious about that, and I want to help you make an informed decision of what's best for your portfolio strategy. But to the point of we beat VOO, they're absolutely right. If you look at my $5 a day history here on VOO, look at the past 30 days, VOO dividend was only $20.56. That's what caused this comment, because in my last video, I was kind of doing a recap and I had a pending dividend for October 1st of $20. Worst part here, comparatively, is that VOO only pays dividends every 3 months. So if you look at the history here, 3 months before that, I made $20.70. 3 months before that, $16.29. Of course, $89 a month sounds so much better than $20 every 3 months. So you might be looking at this right now saying, okay, so why wouldn't this comment make sense? Let's hop over to the screen so I can break this down and show some wisdom, some knowledge, so you can make the best informed decision. Let's hop over to the screen. So here we see SVOL, $21.25 per share. But look at that dividend yield. That's a fantastic dividend yield. Very cool. But let's take a look at some things. Let's go to charting. Now this is on Seeking Alpha. I totally recommend it to check this out for yourself, because it gives you the opportunity to really look at some research on a whole nother level. In fact, you can get a special deal by using the link in the description below if you want to. Let me add my fund, which is VOO. That's the S&P 500 that I've been investing $5 a day into. We're going to update the chart. Now, this isn't accurate. And the reason this isn't accurate, because you could say, well, these percentages make it a different story. But there is a difference between price return and total return. And what we have to do is make sure that we always look at total return when it comes down to performance. The reason being is we want to factor in all of the dividend money that was paid out in all of these different funds. So I'm going to go over to select metrics, and I'm going to X out of the price return, and I'm going to come down to performance, and I'm going to select total return. So if you want to get this, you want to follow along, this is exactly what you want to do, total return, to give you the most accurate example. Let's hit update chart. Now this now includes all of the dividends that are paid out. And here is the trick of the trade. Take a look at the last 1 year. You can see VOO on a beautiful rise, whereas SVOL has only returned 14% with the dividends that were paid out. These are all of those, whether that's $89 a month or whatever your dividend rate is, that monthly payment factored into the total return. Return is important. Return is how much money you're getting back in your investment as a result of making the investment in the first place. So, you're putting all your hard-earned money into a fund. You want that fund to grow. You want your money to make more money for you. But with SVOL, even though you're getting the dividends, you're actually getting shortchanged as a result of those dividends being reinvested at only 14.17% versus you could have had in the last year 40.67% on VOO. If I scale up to 3 years, you can see another difference here where VOO is still beating SVOL by 10%. So with the dividends, you're still reducing the ability to grow by 10%. Now you may ask, what about other dividend paying funds? Well, let's take a look at them, because one of the ones that I use a lot is SCHD. But I will tell you that is based on a different strategy that I have. That is not part of my growth portfolio because SCHD is not that good at growth. It's really great for monthly income. So if you're an older person, let's say you are in your 70s or 80s or whatever you are, and you're retired, you may want to lean more on a conservative fund that will not drop if a crisis happens. You want to make sure that you have enough dividend payments coming in that's almost like not necessarily guaranteed, but very close to being guaranteed. You want to lean on that, right? You want that dividend payout. But if you're young and you have a long time horizon, you don't need guaranteed income. Your income's coming from your job, and therefore, you're missing out on growth. So take a look at SCHD. I'm going to update the chart. In the last 3 years, you can see a similar story. In fact, SVOL is beating SCHD at only 21.44% in the last 3 years, comparatively again to that wonderful VOO at 33%. Now, I can't do 5 years and 10 years right now because SVOL was not around for that long, and that's not fair. I want to compare apples to apples. But if I do go to 5 and 10, you'll see a difference between SCHD and VOO. So you can see still VOO beating SCHD in overall total return. That's money in my pocket. That means more to me than what I get paid in a dividend. So that's, again, very, very critical. What about a single dividend paying stock? Great question. I don't know. Think of some good ones. I know a lot of people talk about O, which is Realty Income, another monthly paying dividend stock. It's a dividend company. Really good one. ABBV is another one. ABV is one. So let's do that. Let's take a look at those. So we're going to update the chart. And again, I think this is an interesting point of view. There's only one that's kicking the butt, and that is ABBV. So that's you putting all your eggs into one basket, one company, but that did pay off beautifully well compared to VOO. That's the one that's beating. So you're getting these great dividends and you're getting growth, and that is the benefit. O, not looking good. Even though you got all those returns, maybe you reinvested. This is what this is showing. Dividends reinvested, but their total return was only 1.27%. So it's like a little kind of thing that you got to think about. Even though you're seeing that monthly dividend payout, you really need to look at your percentages. Am I getting the money that I'm putting into the stock market in growth? And if I'm not, I got a problem. So that's the real thing that you need to think about is the dividend trap. And that is somebody that only focuses on, oh my gosh, this pays a high percentage. So I want to chase after that because I can make $5 a month, $100 a month, $1,000 a month in dividend payouts. But you're actually only growing at next to nothing comparatively to VOO. I'm going to give you one more example and show you where this can be very, very powerful. This is really extreme when it comes down to something like JEPI. JEPI is only at 25%. That's another big one that people talk about compared to VOO at 33. Let's look year to date. Year to date, we have a JEPI at only 13. That's with the dividends paid and reinvested. That's so important to remember. 13% compared to VOO at 23%. And there's SVOL at only 5%. If I go to JEPI and I take a look at that percentage, let's say, okay, so the yield is 7.13%. I come back here and 7.13% is the dividend payout I'm getting out of my portfolio. So if I have a portfolio of, let's say, $100,000, and what you're going to do is you're going to take a look at your 7.13% that you have with JEPI. That means your total income each year is $7,130 based on the $100,000 you have invested in JEPI. That's your dividend payout, $7,130. But all you would need to do in that case is take out $7,130 or 7.13% out of your VOO portfolio. You'd still get the same amount of payment, you see, but you're growing at a higher rate. Let's take a look at that, for example. If you take 13.62% and you minus that 7.13% in dividends, your growth rate was 6.49%. That's it. Your JEPI growth rate was only 6.49. But if I take out 7% of my VOO, 7.13, my growth rate is much higher at 16.61%. That is the big difference. I can still withdraw money out of my portfolio, out of my VOO, and basically treat it like a dividend if I need that income. and I'm still growing at a faster rate than I would with a dividend paying fund. That's the trap that people fall into. And I used to talk a lot about dividends on the channel. I know a lot of you might be like shocked at this, but it's important to know the details. It's important to look at the total return percentages and say, is my strategy paying off the way I want it to? And that is where we do the magic. Comment below with your next question. Check out this video next, and we'll see you on the next video.